Stephanie, one thing that Mike didn't bring up that you're focused on is the ECB. You're sort of surprised it's not getting more attention?
Well, yeah, because I think that they had a major pivot. They're following the Fed, right, to let inflation run hot. Even though they've been trying to let inflation run hot, so is the Fed, and we haven't seen it in about 10 years or so. So I don't know, Courtney, this year to me seems like the big stories are peak growth or not, inflation, is it transitory or not, and what is happening in the bond market. And I think you can step back and say, yeah, we are at peak growth, but we're going to stay at above trendline growth for the foreseeable future. I think you could do 4% growth next year. That's still very good, by the way.
Very good.
Down from about 8 or 9% this year, right? So we're gonna see good growth. We are going to see inflation. I don't think it's all transitory. And I don't even know how long transitory really is, because we have these supply chain issues that are clearly going to stay with us for a long time. You follow retail. You see all of the bottlenecks that are happening, right? So I think you're going to see a little bit more inflation and low interest rates, by the way. Let's embrace it, because that's really good. These three combinations, a little bit better growth, a little more inflation, and also low bond yields. I don't know if bond yields stay this low, but I do think that let's watch what the Fed is doing and also what the ECB is doing. Oh, by the way, the BOJ as well.
We are going to cover Courtney's retail a little later in the show. But firstly, let's hit the banks, because those yield moves mean that we have had a tough couple of trading days for the banks. The latest bit of selling is very much because of those yields falling. So those investors who had hoped we're moving into a new era of higher and rising net interest margins and net interest income, getting worried that their hopes will be dashed, or at least take longer to be realized on that front. That said, banks really started seeing profit taking at the start of June. Citi here shows that move precisely. But it's not just because of yields, also because of warnings ahead of earnings, which, by the way, start next week. Citi definitely down more than the others since the start of June, but quite a few of them down around 10%. Citi there, as you can see, down 15.5% since the start of June. Stepping back a bit, though, what we're seeing really is, firstly, banks are still up a lot this year and just pulling back a bit. And secondly, 2021 is proving to be more of an extension of 2020. By that, I mean good for the capital market players, more so than traditional lenders, as that steeper, higher yield curve gets delayed. And you can see that Goldman Sachs, Morgan Stanley outperforming the regionals and the broader KBW banks index to the tune of 10 to 15%, depending which one you're looking at. And Steph, you have a bit of both, Wells Fargo, Morgan Stanley. I know we discuss that often, but this yield move is a disappointment for the Wells Fargo of that pairing, no doubt about that.
Yeah, there's no question. And, oh, by the way, Bank of America as well, which I also own. But, look, I think you have to also step back on the banks and just say, let's own some special situation stories that are less yield curve dependent. And that's one of the reasons why I do like Morgan Stanley, because the CEO and the team have actually diversified the company with their M&A with Eaton Vance and E-Trade. And they have record investment banking backlog that I expect to continue. They just doubled the dividend, and they're going to buy back stock when they can. They're in their quiet period. So Morgan Stanley actually is down 7% from its high, but it's underperformed Goldman by 10% year to date. So that's why I think that one is really very interesting. Yeah, Wells is definitely yield curve dependent, but they are a restructuring story with a new CEO and a cost structure that's way over bloated at this point, and that's what they're focused on. And oh, by the way, they're shrinking to grow via asset sales, and they doubled the dividend as well, and they're going to do a buyback of $18 billion. So I think that's nice support at 1.1 times book. I think a lot of the bad news is actually priced in there.
Shepard Smith here. Thanks for watching CNBC on YouTube.